Grant Cardone says never buy a house, always rent. He's actually right about the math in today's market, but then he tells you to invest in his deals instead. And that's where I think his advice becomes just a bit self-serving. Hi there. I'm Ella Gerfinkle, senior loan officer with 30 years of experience and over 2,000 families served over my lifetime. Today, I'm going to analyze if Grant Cardone's housing advice is sound, but I'm also going to question his investment recommendations. Where Grant gets it right. Grant's core argument about renting versus buying is mathematically sound in today's market. He correctly identifies that homeownership ties up capital in a non-liquid asset with significant carrying costs. His example of preferring to pay $2,400 in rent versus $2,400 in mortgage payments makes sense because the renter has flexibility while the homeowner has additional costs: property taxes, insurance, maintenance, opportunity costs of the down payment. So in many markets, you can rent for 20 to 30% less than the total cost of ownership. That difference can be invested in liquid, diversified assets. The problem with Grant's alternative is where his advice becomes just a bit problematic. After convincing you to not buy real estate directly, he promotes investing in his real estate syndications and funds. Grant's typical syndication structure includes 2 to 3% acquisition fees, 1 to 2% annual management fees, 6 to 8% preferred return to investors, then a 70-30 or an 80-20 profit split favoring the general partner, Grant, above the preferred return. If a deal returns 15% annually, investors might see 6% preferred plus 30% of the 9% excess, roughly 2.7%, totaling 8.7. Grant keeps 6.3 plus all fees on investors' money. Now, let's talk about the fee structure. Let's examine the real cost of Grant's fee structure. On a typical $20 million syndication, for example, acquisition fees would range between $400,000 and $600,000. Annual management fees between $200 and $400 yearly. Profit splits favor Grant significantly. Disposition fees upon sale, another 1 to 3%. Over a 5-year hold, Grant might collect $2 to $4 million in fees, regardless of investor returns. Now that's a 10 to 20% of the total investment going to fees. Compare this to a REIT with 0.5 to 1% annual fees and complete liquidity. So here is the liquidity problem then. Grant syndications typically lock up investor capital for 5 to 7 years with no liquidity options. If you need your money, you're stuck until Grant decides to sell. This liquidity should command a premium return, but after fees, many syndications underperform liquid alternatives like REITs or real estate ETFs. A more honest approach? If you agree with Grant that renting makes more sense than buying, consider these alternatives. Real estate ETFs with 0.1 to 0.5% fees and daily liquidity. Direct investment in rental properties in cash-flowing markets. REITs with professional management and transparent fees. You can get real estate exposure without enriching Grant through excessive fees. Grant's right that renting often makes more financial sense than buying in today's market. But his solution, investing in his high-fee syndications, primarily benefits Grant, not the investors. So if you're going to rent instead of buying, invest the savings in low-cost, liquid investments. Don't pay someone else's fees to access real estate when you can do it more efficiently yourself. The math on renting versus buying should be based on your situation, not on what investment products someone is selling.